Hello and welcome to this 15th episode of Investing Not Rocket Science. Investing doesn't have to be rocket science, and this is our non expert guide to portfolio management. Okay, what have we done so far? In episode 1, I defined a basic portfolio framework. The objective of this portfolio is to uh, beat inflation and an equity index. I intend to invest into equities and bonds and actively manage this portfolio without the use of leverage with a time horizon greater than 5 years. And the investment universe I'm looking at are the developed and emerging markets. From episodes 2 to 14, I analyzed 52 stocks, 4 bonds. And this portfolio is long 10 stocks and 1 bond and short 1 stock. In this episode, we're going to look at a market update from the previous week, a portfolio update, and evaluate healthcare stocks, specifically GlaxoSmithKline, Smith& Nephew, Sanofi, Novartis, and Novo Nordisk. All right. Equity markets were up in the beginning of the week, down towards the mid of the week, and finally closed on a positive note. Bond yields and the dollar index ended lower for the week, while gold and crude oil were up. Okay, what were some of the key events and data from last week? The Federal Reserve increased interest rates by 0.25% to the range of 4.75 to 5%. This was discussed in detail in the previous post. Existing home sales increased in February to 14.5% month on month, as median sales prices was negative year on year for the first time in 10 years. Amazon announces a 9,000 job reduction in addition to the 18,000 which it announced in December last year. And as the US contemplates a TikTok ban, its CEO offers a risk mitigation plan, Project Texas, to store all user data in the United States. Shares of Block fall 17% on a Hindenburg report that the Cash App lacks controls and highly inflates its transacting user base. Inflation in the UK increased 1.1% month on month, and the consumer price inflation is up 10.4% year on year. In portfolio news, shares of Deutsche Bank fell sharply on Friday. It was down 14% at one point in time. Um, in portfolio news, shares of Deutsche Bank falls sharply on Friday. It was down 14% intraday before closing lower by 8.5%. This followed a steep rise in its credit default swaps, which are the cost to insure bondholders against default. Asked if Deutsche Bank could be the next Credit Suisse, the German Chancellor Olaf Scholz said there is no reason to worry. Deutsche Bank has thoroughly modernized and reorganized its business and is a very profitable bank. This is as reported by the Associated Press. Okay, let's look at the portfolio. The portfolio is up 1.4%, while the benchmark index is down minus 4.3%. This is since the inception of this series, which is February 14th, 2023. In terms of asset classes, all have positive contribution to portfolio performance, except for real estate, which we picked up on Friday of last week. All right. In terms of portfolio details, Deutsche Bank has seen a 27% drop in value since the time I purchased it and added it to this portfolio, followed very closely by Citibank with a minus 14% drop. These are the largest detractors in this investment portfolio. The highest gainers is Google, which has gained 17.8%, followed by JD.com up 8%, and Glencore, which is up 6.3%. Okay, that's what the portfolio looks like. All right, we're going to look at healthcare stocks. Why healthcare stocks? Some of the reasons are it has long term growth potential. The healthcare industry is expected to continue growing as global population ages. Demand for healthcare services and products is likely to increase. It's defensive by nature. Healthcare stocks have been viewed historically as a defensive investment because people will always require healthcare regardless of the state of the economy. Healthcare companies are often at the forefront of innovation and research and developing new treatments, drugs, and medical services and devices. And so this can lead to significant growth potential if a company's products are successful. Obviously, it provides diversification as the industry is generally not closely tied to other sectors of the economy. And finally, because of social impact, uh, quite a few people choose to invest in healthcare stocks because of the social impact of this industry, which is focused on improving people's health and well-being. Okay, in terms of company financials, GlaxoSmithKline leads the way with a low market cap to revenue multiple at 1.9x and high earnings yield at about 8.3%. However, it has negative free cash flow and a current ratio lower than 1. All right, Sanofi, although it is trading at 2.7x, which is a higher revenue multiple, has positive free cash flow of about 19.8% and a good earnings yield of 7.2%. Its current ratio is also ideal at about 1.4x. Okay. In terms of efficiency, valuation, and volatility, Novo Nordisk has the highest operating income margin at about 42.7% and a low debt to equity at about 30.9%. However, the stock is at a high PEG ratio and the price to tangible book value is at about 73.6x, which is quite expensive. This is followed closely by Novartis at about 67.1x. Okay. Novartis and Smith and Nephew have negative free cash flow, sorry, negative PEG ratios. GlaxoSmithKline has the most ideal PEG ratio, followed closely by Sanofi at 0.42. And the operating income margin for both are around 25%. However, GlaxoSmithKline has a negative price to tangible book ratio. Okay. Let's look at trends in company financials. In terms of trends, Sanofi has the most stable and consistent trend when evaluating any of these financials. We see here that Novo Nordisk has the highest operating income margin. Expenditure, interest expense, unlevered free cash flow. Okay. And these are the inventory days outstanding, led by Smith and Nephew, followed closely by Novo Nordisk, and Sanofi and GlaxoSmithKline are close by. Okay. In terms of fair value, upside potential, and dividends, I'm assessing fair value and upside potential using two methods: discounted cash flow analysis and an analyst fair value estimate. While the DCF model method is objective, the analyst fair value is subjective to the view of the analyst. Both are, of course, important, and an average of the two tends to provide a good indication of upside potential. So, going by this method, GlaxoSmithKline sees the most upside potential, followed closely by Sanofi. In terms of dividend yield, Sanofi leads the way, followed by GlaxoSmithKline and Novartis. All right. Going by this evaluation and the semi-quant method that was introduced in the previous part of the series, Sanofi is the pick from these five companies to be added onto the portfolio. That's the graph of Sanofi, which is currently trading at the upper end of this range that it has been in the last 5 years. So if the market sentiment turns negative, then there is at least a 30% fall to the lower end of the range. That's the risk here. However, this is the stock that we're going to add to the portfolio today, and the other stocks go into the watch list. In the next part of the series, I'm going to look at adding more stocks to this portfolio, and also I'm going to try and answer the question about whether I should continue to hold Deutsche Bank in this portfolio, and Citibank, or should they be replaced, or do nothing about them, or add to these positions? This is something that I'm going to look at later this week, plus other stocks that I can evaluate to add to this portfolio. All right, this is investing, not rocket science. A series on building and managing an investment portfolio. None of this is expert advice. I'm just learning alongside you. Please visit our website for the full disclaimers and terms of use, and you can follow us on any of our social media channels or subscribe to our mailing list on www.claritech.app, and we'll keep you posted of the most recent updates to this series. Thank you very much for watching, and I look forward to seeing you in the next episode. Bye bye.